It's the earnings we've all been waiting for. Disney reported some earnings down 2.5% after hours after being down 2% in the normal trading session. Under $100 now in after hours trading. Let's take a look. This is obviously the earnings report that everyone really wanted to see. That's what we wanted to see. So let's take a look at this. Yikers! Non-GAAP EPS of 60 cents missed by 30 cents. Oh gosh. GAAP EPS of 26 cents missed by 47 cents. Son of a gun. Well, it's ugly. It's ugly. On a revenue perspective, though, let's be clear. Revenue of $18 billion, up 20.7% year over year, is massive. Disney Plus subscribers were 33.5 mil versus 26.5 mil in quarter one. ESPN Plus subscribers were 7.9 versus 6.6 mil. Obviously, that ESPN Plus is an interesting number. If you think about the fact that we don't have live sports, ESPN Plus is an interesting one. I think maybe there's a potential that people are trying to feed on that and really trying to find these opinionated, sports-related broadcasts, which Disney Plus will, ESPN Plus will fit the bill. Disney Plus obviously rocking it massively. This is a number that I believe will be 50 million by the end of the year. By the end of next year, probably closer to 80 million in my perspective. So I could be wrong on that, but I do believe it'll be 50 million by the end of the year for this. And I could be wrong there, but I think that they are on pace certainly to hit that by the end of this year. Back to that EPS line, it's horrible. 26 cents. I mean, that's a massive fall in earnings per share, and there's a lot of reasons for it. And I've mentioned this before. We think about the increased intense amount of expenses that you had here in just due to this whole pandemic. The amount of increased expenses is insane. They've shut down all of their parks and travel. Massive. And now that streaming is going to be one of their major sources of revenue, streaming is not nearly as popular. Not nearly as popular or as profitable. Sorry, not popular. I meant profitable. Come on now. You know I meant profitable. Streaming's not nearly as profitable as those the physical areas that they typically will make revenue off of. So that is where you see this EPS miss. What scares me on this aspect is that revenue line for next quarter, as well as that EPS line. Is it going to be a negative? I don't know. Obviously, they won't have Parks and Rec at all for this year, so we'll have to see how they survive in revenue with that. If you think about the addition of Disney Plus subscribers, it's massive. I mean, that's an additional, if you're at 33.5 million, and let's say the average person's got the $6 plan, I mean, that's a lot of money. I mean, 33 million, but it's times 6. So let's just give an approximation of around 190. I think there's a little bit over $190 million that they're getting. That's right, a little over 190 million that they're getting monthly. By the way, 190 million monthly. So that's massive. That's massive amounts there, even just off their 33.5 number that they reported at the end of this quarter, and it's even higher from then probably. So that's just crazy amount of revenue that they can add in all aspects of it. So you think about that 190 million. If you equate that out to a full year, we're talking like 240 or 2.4 billion around there. So that's massive amounts there, just off the number they have right now. And that number for subscribers will keep increasing, so keep that in mind. Revenues came in ahead of expectations, with pandemic effects arriving late in the quarter. As I said, EPS fell 93% to 26 cents, excluding items affected comparability. It fell 63% to 60 cents, well below the consensus of 90 cents. That's rough. Revenues, though, were up 21% year over year, easily clearing the bar for 17.5 billion, driven by solid media networks growth and a few billion in new DTC/international revenues. Really a lot of it for streaming, offset by a 10% drop in parks. Now, the thing with this is that 10% for parks It's going to become more like a 90% in the next quarter, right? This is going to be massive. They're going to lose all the revenue from that. So if you think about it, they're going to need a lot more to help accommodate that extra, those $4 billion that the parks account for. So let's see how they do that. I don't know how it's going to look. Results reflect consolidation of former 21st Century Fox and Hulu, and revenue by segment. Media networks, 7.26, up 28%. Parks, experience and products, 5.5 billion, down 10%. And they're not going to lose all of that, obviously. For parks and experiences, they will have a little bit in terms of experiences, but products is really going to be the main driver in that category. We talk about Baby Yoda merchandise. I mean, come on now. They know what they're doing. They're going to try to sell more merchandise because of this. Studio entertainment, up 18%. Direct-to-consumer, up 261%. And again, that looks massive just because they didn't have a streaming service before, really, that they counted on. Now they have freaking Disney Plus, and they're rocking it. Son of a gun, they're rocking it. So they don't have an earnings presentation ready yet. So we're going to look just right off here, right off this release, and we'll see what we got there. So revenue, you see a year-over-year change of 21%. It was nearly $15 billion last year. Now it's $18 billion. Gotta love that. 6 months ending, you see a 29% change in revenue. And again, that's the Disney Plus factor there. That's a massive grower in revenue, even with those Fox 21st Century assets that have already grown the revenue pretty massively, just, by the fact that they are as is. I mean, it's extra revenue no matter what. So good for them, but very good in terms of that. Free cash flow fell 30%. Not unexpected, for sure. I mean, that's not odd at all. Net income from continuing operations fell 91%. I mean, it's what you'd expect. I mean, there's not much you can expect, but a positive number is certainly not awful. So that's going to be interesting. Obviously, with stores reopening, as far as their retail is concerned, and their product sales, that'll be pretty big for them, I think. But next quarter is going to be rough. If you just look at what you have rocking here, next quarter is going to be rough, because that parks, oh my gosh, last year was $6 billion, and that's money they're losing out on. They're not going to lose all of it, obviously. And even 6 months ending, you saw this $13 billion. Gosh, that's crazy. So you're not going to lose all of that money, obviously. It's around $24 billion a year, if you think about that, for parks and travel. Right now, that's going to drop to really be carried entirely by products. So how's products going to take over that? It's interesting to say. So media networks increased 28%. So you see cable networks are up 17% and broadcasting up 49%. Pretty cool in that aspect. SegOp income of $2.37 billion. Cable networks revenue is up 70%. This increase in operating income was due to consolidation of 21st Century Fox businesses, primarily offset by a decrease at ESPN, and to a lesser extent, domestic Disney channels and Freeform. So nothing super crazy there. Broadcasting at 49%. Again, largely due to consolidation of 21st Century Fox, largely reflecting program sales, and to a lesser extent, an increase in our legacy operations. Pretty cool. So SegOp income for parks decreased 58%. Not good. Lower income was due to the decrease of both domestic and international parks and experiences businesses. Not a shocker. So closed domestic parks, cruise lines, and business in mid-March, while Asia parks and resorts were closed earlier this quarter. As a result, volumes were negatively impacting the quarter. No shocker. Prior to closure, volumes and guest spending were higher compared to the prior year quarter, and you can see that because they nearly met those what they hit last year, and they were really missing a full month out of that, all things considered. So definitely crazy stuff. So costs for the quarter were higher compared to prior year quarter due to an increase in domestic parks and experiences driven by expenses for new guest offerings. Yeah, nothing crazy there. Studio entertainment up 18%. Again, they're going to say partially offset by 21st Century Fox consolidation. Theatrical distributions was negatively impacted, obviously, as theaters were closing. And again, I don't necessarily know what it looks like. What's going to happen here as far as after this? I mean, movie theaters, are they just going to be run by Disney pretty much? Or who knows? Because I know AMC right now is having a big ordeal with Warner Bros. I think it's Warner Bros. Who is it? One of the major producing companies. I don't know why I can't think of right now. And they pretty much aren't going to show their movies at all in studio, or I should say in theater. So that'd be crazy to see what that does. I don't necessarily know what that means to anyone, but it's going to be weird to see. Definitely will like to see that. But you see, as far as just wild stuff, as far as subscribers are concerned, Hulu total, you see 32.1 million people, 33.5 in Disney Plus, and ESPN's got 7.9. And again, that's an increase year over year of over 100%. That's massive. That's just crazy stuff. And even Hulu rose 27% year over year. More for live TV and SVOD. And again, you're going to see that a lot. So that's obviously video on demand, as you know. But the live numbers are going to increase more as more people are ditching cable. You're going to see that number for Hulu increase quite a bit more because that live TV is actually a very good offering. It's a lot cheaper than you were to go to another cable subscription. It really just is. Last thing I want to look at, obviously, one thing to mention is as far as dividends were concerned, this company has definitely suspended their dividend for the first half of the year, which I 100% understand. Normally they pay it in June. They're not going to. That doesn't shock me one bit, and I don't necessarily anticipate them. I don't anticipate them paying that dividend because they shouldn't. They're a company that couldn't hit even the mark. Right now, their dividends, I think 60 cents. Shoot, what is it? I can't even remember. But they're not paying it. Obviously, their EPS doesn't meet it though. Their EPS does not meet that whatever they would pay out. So it's not unexpected. So from a cash and cash equivalents perspective, this company is loaded on cash now. They took a big cash position for a good reason. Obviously, they wanted to make it through this with enough cash. $14 billion in cash versus $5 billion 6 months ago. Crazy numbers right there. It's wild. So overall, from a total current assets perspective, you got $33 billion versus $28 billion last year, or 6 months ago, I should say. Total assets in general of $206 billion versus $193 billion. Good increase in terms of assets. Liabilities, though, you will see a difference here. Nothing too major, though. Current liabilities of $35 billion versus the $31 billion last year. So again, they're right around on track with their assets. But if you look actually on the long-term perspective, from long-term perspective, total equity for shareholders is actually $94 billion. So they've got $94 billion more dollars in assets than they do in terms of liabilities, which is massive. We're talking about, obviously, from a total perspective. That's pretty big. I definitely am excited about that. This company's got the money, and obviously they're going to get through it just fine. Disney Plus is the driver, and again, like I mentioned, 50 million by the end of the year in terms of Disney Plus subscribers. It's not their goal that they set, but I think it's my goal that I think they'll hit. And I don't think it'll be that difficult for them, to be all kind of honest, all things considered. As people get back to work more, especially, and people might think about cutting their cable more even, and even then, Disney Plus is a fantastic option. And as more exclusives come in, we talk about Season 2 of The Mandalorian coming out later this year. Massive stuff for this company. Disney Plus is going to be big. I don't know what quarter 2 is going to look like for this company. This stock could drop. It could be stagnant until quarter 2. Who knows? But I like this company a lot long term, and I think after this year, things are going to be wonderful for this company. It's going to be crazy. Just the amount that this company is bringing home in revenue. It's going to be crazy, and I hope you stay home and just listen to it. Just watch for this. It's going to be good, guys. It's going to be good.